Hey everyone, and welcome back. Today we're tackling something that I know a lot of you have been asking about, especially with how crazy the markets have been lately, high-yield dividend stocks.
Yeah, it seems like everyone's looking for a little more stability these days, and who can blame them?
Exactly. It's like, why not get paid just for owning a piece of a company? But we both know there's more to it than just grabbing whatever stock has the highest yield, right?
Oh, absolutely. Those sky-high yields can sometimes be a red flag.
Mhm.
It's about finding that balance, a company that pays a solid dividend, but also has a track record you can actually trust.
That's what we're digging into today. We've got a ton of research here, articles on the top picks for 2025, some in-depth market analysis, even a clip from a finance podcast that explains all the basics really well.
Speaking of basics, before we get into specific companies, maybe we should do a quick level set. When we talk about dividend yield, we're talking about the annual dividend payment per share divided by the current share price. Basically, it's the return you're getting just from those dividend payouts. Got it. So a higher yield means a bigger payout, but like you said, it's not just about chasing those big numbers.
Exactly. We need to look beyond just the yield and think about the overall financial health of the company. Can they actually keep those dividends coming over the long term? That's where choosing the right sectors comes in.
That's something I've seen pop up a lot in the research too. So what sectors are looking particularly strong right now for dividend investors?
Well, when things are a bit rocky, people tend to look for safety and reliability, right? So sectors like utilities and consumer goods often come to mind. People always need electricity. They're still going to buy toothpaste and laundry detergent no matter what the economy is doing.
Yeah, that makes sense. Investing in those everyday essentials.
Precisely. You're investing in the things people can't live without. And then there's another sector that has a unique angle on stability real estate investment trusts, or REITs for short. They own and manage income-producing real estate, like shopping malls and apartment buildings.
Ah, REITs. So it's like getting a taste of the real estate market without actually having to be a landlord.
You got it. And here's a bonus. REITs are actually legally required to pay out at least 90% of their taxable income to shareholders as dividends. That's why they often have yields that are higher than a lot of other types of stocks.
Okay, that's pretty interesting. But what about the risks? I mean, everyone knows real estate values can go up and down.
Of course, there's always some level of risk, but with REITs, you're benefiting from diversification. Instead of owning just one property, you're invested in a whole bunch of them, spread across different areas and property types.
Yeah.
So that helps spread the risk around a bit.
Okay, that makes sense. So we've got utilities, consumer goods, and REITs as potential safe havens in the dividend world. Where do we go from here?
Well, now we get to dive into some actual companies. How about we start with a classic choice for dividend investors, Johnson & Johnson. They're a healthcare giant. I bet you've got some of their products in your bathroom right now.
J&J, definitely a name everyone knows. They make everything from like baby shampoo to really advanced medications. What makes them such a standout in the world of dividends?
Well, they've got a dividend yield of around 2.7%. Might not sound like the most exciting number out there, but here's the thing. They've been increasing those dividend payments for over 50 years straight.
Wow, 50 years. That's impressive consistency.
It really is. And it shows you they're committed to sharing those profits with their investors. But what really sets them apart is that they focus on essential products.
Essential products, huh? Tell me more about that.
Think about it. People need healthcare products no matter what the economy is doing. Whether it's good times or bad, folks still need bandages, pain relievers, and prescription drugs. So Johnson & Johnson has a really steady revenue stream, which means those dividend payments are likely to keep coming.
Ah, I see. So it's like investing is something people will always need.
Exactly. It's that reliability that really attracts dividend investors.
Okay, J&J definitely a solid contender. What other dividend superstars are on our list today?
How about a company that sends you a dividend check every single month? Realty Income Corporation. They've even trademarked the nickname the Monthly Dividend Company.
Hold on, they pay dividends monthly. That's not something you hear every day.
It's true. They've been doing it consistently for over 50 years. And with the yield hovering around 4.7%, they're definitely attracting attention from investors who are focused on income.
Okay, I'm definitely interested. How do they manage to make monthly payouts when most companies only do it quarterly?
It all comes down to their business model. They own tons of commercial properties and have them rented out with long-term leases to reliable tenants. Those steady rent payments are what keeps those dividends flowing like clockwork.
So it's like owning a tiny piece of a massive real estate empire. Not a bad deal. But with so many properties, managing them all must be a nightmare.
That's the cool part about REITs. You get all the perks of owning real estate without actually having to deal with the day-to-day headaches. Realty Income Corporation takes care of all that for you.
J&J for stability and essential products, Realty Income for monthly payouts, and real estate exposure. This is a pretty good start. What else is in our research pile?
Well, it wouldn't be a dividend conversation without mentioning the consumer goods giant, Procter & Gamble. They're the company behind a bunch of brands you probably use every day. Tide detergent, Gillette razors, Pampers, diapers, you name it.
P&G, they're practically a staple in every grocery store. What makes them such a dividend powerhouse?
It's actually similar to what we were just talking about with Johnson & Johnson.
Yep.
They make essential products that people buy no matter what's going on in the economy.
Yeah, it makes sense. People are always going to need laundry detergent and diapers. But does that actually translate to a good track record of dividend payments?
You better believe it. Their dividend yield sits around 2.4% right now, which might not sound huge, but get this. They've been increasing those dividend payments for 66 years in a row.
Wow, 66 years. That's even longer than Johnson & Johnson. They're serious about rewarding their shareholders.
They are. And that consistency is a really good sign about their financial strength and their confidence in their future growth. Plus, they're always coming up with new products and ways to innovate. That helps them stay ahead of the game.
So P&G is another strong contender with those essential products, the long history of dividends, and a knack for always innovating. This is shaping up to be a pretty impressive list. What else do we have?
Well, if you're open to something a bit riskier but potentially more rewarding, there's AT&T. They're a huge player in telecommunications, and their dividend yield is currently sitting around 6.4%.
Oh, wow, that's a number that grabs your attention. But I've heard that AT&T has had its share of struggles in recent years. Does that worry you at all?
You're right. Higher yields usually come with higher risks, and AT&T has definitely faced some challenges, like competition from those newer telecom companies.
So it's like a trade-off. You might get a bigger payout, but there's also more uncertainty.
Exactly. That's why it's crucial to do your homework before investing in any company, especially one with a higher yield. You really have to understand their overall financial health.
Got it. High yield is tempting, but we need to make sure there's substance behind it. So, AT&T, a potential high reward, high risk option. What else is on our list today?
Ready for a company that's practically synonymous with dividends? Let's talk about Coca-Cola.
Coca-Cola. I mean, they're everywhere, but are they really that great for dividend investors?
Never underestimate the power of a brand that everyone recognizes and over a century of experience. Coca-Cola has been paying dividends for over 100 years. That's right, over a century.
Wait, over a century of dividends? That's incredible. They must be doing something right.
They definitely are. Think about it. Their drinks are sold in just about every country on the planet. That global reach gives them a level of stability that's hard to match.
Plus, people are always going to want a refreshing drink, whether it's a classic Coke or one of their other brands. They've got some pretty dedicated fans.
Right. And with a dividend yield around 3%, they strike a good balance between a decent payout and that solid track record of reliability. They've made it through all sorts of economic ups and downs, and they're still going strong.
Okay, I'm starting to see the appeal. Coca-Cola, the global beverage giant with a century of dividend history behind them. This is quite a lineup of companies. We've got healthcare, consumer goods, REITs, and even beverages covered. It seems like there are some really interesting opportunities out there for dividend investors.
There are, but keep in mind, this is just the beginning. There's a lot more to learn about what makes a company a truly good dividend investment.
Right, we still need to figure out how to actually evaluate these stocks, build a well-rounded portfolio, and use the power of compounding to maximize our returns. But I think that's a discussion for part 2 of this deep dive.
I agree. Let's dig into all that after a quick break.
Welcome back, everyone. Okay, so we've met our all-star lineup: Johnson & Johnson, Realty Income Corporation, Procter & Gamble, even AT&T and Coca-Cola. Now, the big question is, how do we use all this to build a dividend portfolio that can actually deliver?
Ah, yes. It's one thing to know about these companies, but actually putting that knowledge to work for you is a whole different ballgame, isn't it?
Exactly. Where do we even begin? I'm ready to put these insights into action.
Well, remember those stable sectors we talked about: healthcare, consumer goods, utilities. Those are a fantastic foundation for any dividend portfolio. They tend to weather those market storms pretty well.
Okay, so let's say I've got a few companies from those sectors that I'm eyeing up. What should I be looking at besides just how big the dividend yield is? What else matters?
Good question. There's actually a lot more to consider than just chasing those high yields. One key factor is the payout ratio.
Payout ratio. Okay, remind me, what was that again?
It's basically the percentage of a company's earnings that they pay out as dividends. So a high payout ratio means they're giving away a bigger chunk of their profits to shareholders.
So a high payout ratio, good news for investors who want those dividends, right?
Well, it can be tempting to see a high payout ratio and think, wow, more money for me. But it can also be a bit of a warning sign.
Oh, really? Why is that?
Think about it this way. If a company is paying out almost all its earnings as dividends, what does that leave for other things? They might not have enough to invest back into the business or handle any unexpected costs that pop up.
I get it. It's like someone spending their whole paycheck and having nothing left for savings or emergencies.
You got it. A lower payout ratio is generally better because it gives the company more flexibility. They have room to increase those dividends later on, or maybe invest in new technology and research, or even acquire other businesses.
Okay, so it's about finding that sweet spot. A decent dividend yield, but not so high that it's unsustainable for the company in the long run. What else should we be paying attention to?
Debt. It's a big one, just like in our personal finances. Companies with a mountain of debt are always riskier. They might struggle to keep up those dividend payments if their earnings take a hit.
So how do we know if a company has too much debt? What should we be looking for?
You want to check out their financial statements and look at something called the debt-to-equity ratio. It basically compares their debt to their assets. A lower ratio usually means they're in a healthier position financially.
Okay, so payout ratio and debt levels are on our checklist. What else should we keep in mind?
Don't forget the big picture. Think about the industry trends. Is the company in a growing industry or one that's facing some headwinds? For example, if you're looking at a traditional utility company, you might want to think about the rise of renewable energy and how that could affect them over time.
Yeah, that's a good point. I mean, even with a great dividend, if their industry is shrinking, that's not a great long-term bet.
Exactly. So always think about the future. Is this company well positioned to do well in the years to come? Are they adapting to how things are changing?
Wow, this is making me realize there's a lot more strategy involved in picking dividend stocks than I initially thought. It's not just about looking at those numbers in isolation.
It is strategic.
Right.
And that brings us to another important factor, innovation. Is this company investing in research and development? Are they coming up with new products or services to stay ahead of the curve?
You know, I was just reading about a company that used to be a leader in its industry, but they totally failed to innovate. They got stuck in the past, their products became outdated, and eventually their profits started to dry up. Guess what happened to their dividends?
Yeah, you guessed it. They probably had to cut them or even eliminate them completely. It's a reminder that even companies with a long history of dividend payments can fall behind if they're not constantly innovating and evolving.
Okay, so we've got payout ratio, debt levels, industry trends, and innovation on our checklist. This is getting pretty comprehensive. But isn't there something else we should remember? Something about not putting all our eggs in one basket.
Ah, yes, the golden rule of investing diversification. It's all about spreading out your risk so you're not overly reliant on any single company or sector.
Right, right. Don't put all your money on one horse. So how do we actually diversify our dividend portfolio? How many stocks should we aim for?
There's no magic number, but a good starting point is to aim for at least 10, 15 different stocks across a variety of industries. If one company or industry underperforms, you've got others to help cushion the blow.
Okay, so diversification check. Spread the risks. Don't get too attached to any one company. Got it. But let's be real. A lot of people get into dividend stocks for that passive income. How can we really make those dividend payouts work for us?
Now we're getting to the really fun part, the magic of compounding.
Compounding. I've heard the term, but I'm not sure I fully grasp it. What's the big deal?
Imagine this, you get a dividend payment, but instead of spending it, you reinvest it right back into the same company that paid you.
So it's like those dividends are earning their own dividends.
You're catching on. It's a snowball effect. Those reinvested dividends start generating their own dividends, and then those dividends earn even more, and so on. It can really supercharge your wealth building over time. It's all about letting time and that compounding magic do their thing.
That's powerful. Sounds like patience is key here.
Absolutely. Dividend investing is a marathon, not a sprint. You've got to have a long-term mindset and be willing to let those investments grow steadily over time. It's about finding companies you believe in and letting them do their thing.
So if we were to sum up everything we've talked about today, we're looking for companies with consistent earnings, a history of increasing those dividends, a payout ratio that's sustainable, and debt that's under control. We also need to think about those bigger trends in the industry and whether the company is innovating and adapting. And of course, we can't forget about diversification, spreading out that risk. Did I miss anything?
I think you nailed it. And remember, this is just the tip of the iceberg. There's so much more to learn about the world of dividend investing, but this is a great foundation.
Absolutely. And before we wrap things up, I know you always like to leave our listeners with something to think about, a little food for thought. Okay, lay it on us. What's the big question our listeners should be pondering as they continue their dividend investing journey?
Well, we've talked about some really interesting companies, haven't we? Johnson & Johnson, Realty Income, Procter & Gamble, AT&T, Coca-Cola. Each of them has their own unique strengths and potential weaknesses to consider.
Right. And we dug deep into what makes a dividend stock worth investing in: consistent earnings, dividend growth, that payout ratio, debt levels, what's happening in their industry, innovation. We really covered a lot. But now what?
That's exactly what I want you to think about. Take everything we've discussed and really consider your own goals and what you're comfortable with when it comes to risk. Which of these companies stands out to you? Which ones are at the top of your list for more research?
I love that. Because what's right for one investor might not be the best fit for another. It's all about applying what we've learned to our own individual situations.
Exactly. And that brings me to another question. What are the things that matter most to you when you're making investment decisions? Is it that long history of dividend increases? Or maybe it's a company's commitment to sustainability? Or maybe you're really focused on their potential for growth in the future?
It's like we've given our listeners this whole toolbox full of ways to evaluate dividend stocks. Now it's up to them to decide which tools are most important for the job.
You got it. There's no single right way to approach dividend investing. It's all about finding what aligns with your own goals, your risk tolerance, and your investment philosophy. It's a personal journey.
This deep dive has been fantastic. We've explored the basics of dividend stocks, dug into some specific companies, and even learned about things like compounding and diversification.
And yet we've only just scratched the surface. There's always more to learn about dividend investing. It's a fascinating world.
So what's your final word of advice for our listeners as they set out on their dividend adventures?
Never stop learning. Knowledge is power, especially when it comes to investing. Read those books, listen to the podcasts, follow what's happening in the news, and never be afraid to ask questions.
And don't forget to have some fun along the way. Dividend investing can be really rewarding, both for your wallet and your mind.
Very well said. It's all about finding those companies you truly believe in and watching them grow along with your own portfolio.
And one final reminder, this is just our perspective. Always do your own thorough research and think about talking to a financial advisor before making any investment decisions.
That's it for today's deep dive. We hope you've enjoyed it. Until next time, happy investing, everyone.